Hi guys, Randall Mauro with RESNN Investments. And today I've got a short video for you talking about whether defensive investing actually works to keep you safe. And first off, what is a defensive investment? And specifically, we're talking about the stock market, and we're looking for investments that are safer and stable than the general market. These are companies that are going to hold up better in a market downturn. So does investing in these types of companies actually work? Does it keep you safer? Well, it's a yes and no answer. The bottom line is everything in the stock market falls. So if you're invested in a very safe company or ETF, you're still going to experience a loss in value during a market downturn, but it's going to be less than investing in a high growth technology company as an example. So keep that in mind. There really is nowhere that's truly safe. The important thing to minimize that is that you shouldn't put all your eggs in one basket. As an example, in 2020 during the COVID crisis, healthcare, which is normally a very, very safe and stable sector, fell more than technology stocks because of the concern as to how they will be impacted. And in 2008, real estate, again, normally more stable, fell much harder than any other stock in the market. So when building a defensive portfolio, ideally, you don't want everything in one place. You want to spread it out and try to find assets that are not correlated. So as one falls, the other is holding steady. The other real big consideration when investing in defensive stocks or ETFs is that they underperform in good markets. So although they protect you in those safe markets, they're going to do less good in the good markets. They're more stable and consistent all around, which may feel great when the market is falling, but you have to remember the market goes up 75% of the time. So over time, you're going to underperform in these type of investments. So what is the better investment? Well, it really is specific to you. There is no right answer. And two very important factors are your time frame and your risk tolerance. If these are retirement funds and you don't need to touch them for 30 years, you can afford to be more risky because you know that over time, those risky investments will recover. They may fall much harder, but they're going to come back. And over time, they're going to outperform. As an example, if you look at the last 30 years, if you invested money 30 years ago and did not touch it, you would have returned more than double if you had invested in the NASDAQ versus investing in defensive sectors like consumer staples or healthcare or utilities or REITs. Those return less than 1,500% relative to the NASDAQ, which was over 4,000%. So it's a sizable difference. With that said, if you look at specific examples, in the dot-com crash of 2000, which lasted until 2002, the NASDAQ fell over 78%. So again, over 30 years, you're doing double as good as a defensive stock, but can you sit through a 78% decline? And that's where we talk about risk tolerance, or what I like to call the sleep factor. If you are concerned that you're going to wake up in the middle of the night fearful that you've lost all your money, then you probably should not be investing in high-tech companies. You want to avoid those 78% declines. But if your timeline is long and you understand that eventually this stock or ETF is going to pull out and be a better investment than any others, then you can move forward and be comfortable. As an important note, the NASDAQ took almost 13 years to come back to break even after the drop in 2000 to 2002. So you had a 15-year time period where you were underwater, where your investment was less than what you paid for. And obviously that's another factor is can you sit for 15 years knowing that your investment is underperforming? That's hard to do, but if you can, it's gonna pay off in the long run. So that's all for now. If you wanna see actual specific numbers, check out the notes below my blog. I've broken down the last number of market corrections and how each of these sectors have performed in each of them. Thank you so much. Stay safe out there. Bye-bye.